I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thanks so much for being here today.
It's a pleasure.
Great. So we're here at PDAC. We're a couple of days into the show. I want to start by talking about gold's recent price activity. What do you think has driven the volatility we've seen, and is there more to come?
Well, I think there are a couple of factors. Obviously, the major thing that we've seen over the last 12 trading days has been the coronavirus and sort of the financial markets waking up to the economic consequences, of the coronavirus through the global supply chain, which is really across all industries. And that led to, the gold price to spike up $120 in 5 trading days, and then come down $100 in 4 trading days, and now it's back up again today. So I think that the primary factor that you're seeing is in the volatility is the financial markets reacting to the coronavirus. In addition to that, you've got we've seen a shift over the last several years where a lot of investors are focusing on futures and options. Mm-hmm. And I think that is contributing to the volatility.
Okay, so I've been hearing this described as a black swan event. We couldn't have expected this. Is it possible, it's not just in the name, it's not really possible to be ready for those things, but what should investors do to prepare? Is it possible, I guess is the question.
Well, it is possible to be prepared for them, because what you have to say is these things occur. Mm-hmm. And what do you do to protect yourself? And obviously one of the things you do is you own gold and silver.
Right.
So it is, to some extent, an anomalous activity, but you can look at history and say anomalous events occur, and they occur with regularity. There's a 100% chance that we will see a recession. In fact, a bunch of recessions in the future. Mm-hmm. The question is when, and how deep will they be, and how will the governments react to them? So you can prepare for unforeseen circumstances by saying, I have to be prepared for unforeseen circumstances. And one of the things you do is you diversify your portfolio, and you use gold and silver as a means of diversification.
Right, and speaking of, learning from the past, and speaking of recession, I have been hearing some comparisons of now to 2008. Do you see that similarity? Do you think we're headed towards a market crash, a market downturn?
No, the similarity I see is to 2001.
Okay.
Where we had a shorter, shallow recession. We did have a big decline in the stock market, and the NASDAQ fell about 86% in the 2001 recession, and the tech blow off and everything. And you have a lot of similarities to what was going on in 2001 right now. 2008 was something quite different, I think. And you had SARS come along in 2001, 2002, okay. Which was on top of it all. And so I think that there's greater similarities there. Mm-hmm. And then, what we keep saying is the similarities are really to the late 1920s, early 1930s,
all right, okay.
Which is much more worrisome, but a longer term issue.
Okay, all right. So within all of this, where could gold be going this year? What does it mean to make those comparisons?
Well, we think that the volatility due to the coronavirus scare sort of dissipates over the course of March, April, into May. And by April or May, we expect gold prices to be calming down. We see them trading around 1550 to 1640 over the course of now through the third quarter. And then we start seeing them strengthening into the fourth quarter. U.S. politics will have something to do with it. Right. The fact that we're now into the Brexit process will have something to do with it. There are other issues that will probably come in. So we're kind of looking at the gold price moving pretty much sideways for much of this year. We do expect much sharper prices, but we don't expect them for another 3 years or so, because we don't expect a major recession for another 2 or 3 years.
Okay, and what would you say, you named a number of things that are happening this year. They all do seem quite big, but they're going to keep gold going sideways. So what would you say is the main driver of gold right now?
Well, the main driver for gold right now is obviously coronavirus.
Okay.
But beyond that, I think that what we've seen is primarily gold being traded as a diversifier against the stock market. To some extent, interest rates. The fact that interest rates are low and headed lower is good for gold, so that people will find the opportunity cost of having some of your assets in gold are reduced. I think that it's really the financial market. What we've seen over the last couple of years is that political issues have taken a backseat to financial market trends in their effect on gold and silver prices, and I think that continues for a while, although one of the trends that we're telling our clients to watch out for is we think that those political trends that I mentioned will probably be more important in 2020 and beyond than they have been in the last couple of years.
Okay, and why would that be? Just because?
Well, I think because what we've seen is it's a string that's being pushed out, and over the last couple of years, those political issues have been worrisome, but they're not of immediate import.
Okay.
And I think that you've seen this, one of the strengths that in our forecast compared to a lot of other people's is that we have been saying for several years the economic expansion can go for some time, and those political issues that you see growing on a global basis and in different countries like the United States, England, other continental Europe, China, Russia, those things will take years to unfold.
Okay.
We're now 3 years, 4 years down the road, and we're getting closer to the point where I think those things come home to roost.
Okay. So we've been talking about what's going on with the gold price. What else is going on in the gold space right now that people should be aware of? I think this time last year, mergers and acquisitions were the big thing that people were talking about. What do you see now?
Well, I think that you're moving toward a period of increased focus on large mining companies looking at mergers and acquisitions. I think it's an ill-advised move on their part, but I think that they'll do it anyway because that's what they do. And the other big trend that we've been watching is the decline in capital flows into the mining sector in general, but into the junior and mid-sized mining companies in particular. So there's really a drawdown in liquidity, and a lot of that some of it has to do with disenchantment with the mining company's performance, but a lot of it has to do with transformations in the broader financial markets, which really is a movement toward indexed investing, ETFs and passive investments and computer-generated investing, away from investing in individual companies and smaller cap companies. And what you're seeing on a global basis, but it's really affecting the mining industry, is a starvation of capital. And that is causing problems for the smaller companies, the junior exploration companies, other smaller companies in other industries, and that's an issue that the world is facing that has yet to be really resolved or addressed.
So how do we deal with that? We're at PDAC, there's lots of small companies down there that would probably be very concerned to hear that. Where do we go from here?
Well, part of our message is that this is one of those things that is a secular long-term transformation in the global financial system, and no one's going to reverse it. The mining industry is completely unable to reverse it. Regulators, governments, even the financial markets themselves are probably unable to reverse it. It's a fact of life. And so the mining industry, large companies as well as small companies, need to understand that the financial system in which they're operating is changing in ways that are negative for them. The key is not to try to change the financial system, but to change your business plan to deal with and cope and thrive and survive and thrive in that changed financial market. So one of the things to realize for the juniors is you're not going to get money from those bigger asset management companies. You need to look at smaller specialist funds, family offices, prominent mining type investors, private equity, because that's where your financing traditionally has come from, and that's where it's going to increasingly come from in the future.
Do you think they'll be successfully able to make that pivot? Because I know people always say mining is a very slow industry to change.
It's very slow, and one of the things that's been amazing is the survival rate. I mean, there will be companies, and there are companies that are making the changes in their business plan and their financial plans to accommodate these changes, but there are a lot of companies that are not even aware that this is going on, and yet somehow or other they survive. And I think that that's probably going to continue to be the case.
I want to just ask one more question about mergers and acquisitions. You mentioned you wouldn't want to see those big companies doing more of it. Is it that you wouldn't want to see it among the large companies, or is it would it be okay if we were seeing that among mid-tier companies,
Well,
smaller companies?
The gold industry and the mining industry in generally, it's very funny because people will say, well, the mining industry in general, the juniors find the properties, and it's very funny because you look at these large companies, and there are large mining companies in the gold sector and elsewhere who have never discovered a mineable property. They only buy them. And the mechanics of the market is the junior exploration guys find these things, they either sell them to mid-tiers who move them forward, and then they're bought by the majors. So that's the organic history, and that's probably going to continue, and it probably should continue. What I don't think makes sense is large companies saying, well, we have to merge with other large companies to get large enough to be critical size so that large institutional investors buy us.
Okay.
Because you can't do that. The gold mining industry is too small for the largest asset management companies to invest in. And again, it's like you shouldn't try to merge, because the top 20 gold mining companies can merge, and they're not big enough for the largest asset managers to get 2% of their assets into them. So what you have to do is you have to be aware of that reality, which senior management in a lot of companies doesn't seem to be aware of, and you have to adjust your business plan accordingly. And you have to say, I shouldn't be going for size, I should be going for profits. Because if I have a well-run company where the guys actually know something about not only mining but gold, which is very rare, I'll mention that in a second. If I have a well-run company that's intelligently run, that understands the market for its product, and it's profitable, I can raise as much money from the smaller funds and family offices and retail investors as I need.
Okay.
In China, you have to pass a test. You have to know about the gold industry to be a mining executive. And you have to go visit jewelry manufacturers, electronic manufacturers, and refiners. I know of one senior executive in a non-Chinese mining company who has visited a jewelry factory.
Okay. All right, I think on that note, we'll leave it there. Thank you so much. That was great. Always nice to have you.
It's always a pleasure.
And once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.